Welcome back. My guest in this segment is our very own capital markets advisor, Steve Misener. Steve, welcome.
Thank you.
Steve, I wanted to start the conversation with the discussion about the general broad market weakness going into Q4 2018, what that means for 2019.
Well, it's hard to say the setup for next year. It's interesting that, first of all, Black Friday was possibly a record-setting for online sales and pretty good for retailers, which shows that consumer confidence is very strong. It's interesting that the stock market in the aggregate is the only marketplace on the planet where people don't rush in to buy things when they're on sale. Mm-hmm. You sell a toaster at a discount, people are all over that. In fact, they're duking it out at Walmart to get a toaster, but you offer them stocks at a lower price, and it's a completely different psychology. Yeah. But the setup for next year is certainly mixed signals right now. Mm-hmm.
Okay, so tax loss selling is always or I shouldn't say always, but is often a perennial discounter of stocks towards the end of Q4. As portfolios start to as money managers start to window dress their portfolios towards the end of the year. But this year we've also got a little bit of macroeconomic weakness as a result of the China-US sort of burgeoning trade war, which looks like it could get hotter before it gets cooler. And then of course we've got uncertainty as a result of the Fed walking back on its commitment to raise rates in the near term. So all of those things seem to me have exacerbated the Q4 end-of-year performance of stocks. Are those things likely to rectify and cause reversal in Q1 2019, or do you think that we're going to see more of the same?
Well, let's try and cover some of those points individually. The first part about window dressing, just for your viewers, window dressing is I guess a term used for professional fund managers to thin out the number of names they have in their portfolios. Typically, over the course of the year, they'll tend to buy more shares of different companies, and then by the end of the year, they would tend to weed and thin out, especially ones that haven't worked out are usually under more selling pressure. They're considered embarrassment positions, and they don't want to show them. And since December 31st is still a key component of final year statements that will go out to individual mutual fund holders and such institutional accounts in the new year, that's the key snapshot. So you've got that weeding out or thinning out of the positions. Secondly, tax loss selling management is key. There have been some big gains this year, both for individuals and for institutions in certain segments. And so offsetting some of those positions where there are losses is prudent tax planning. People typically don't wait till December 28th or 27th to liquidate these positions. They typically do them through October, November, and now we're into December. So tax loss selling is certainly a component, and tax loss selling does lead to weakness in the markets. And also, the volumes are thinning out a bit right now, so you've got fewer buyers around, and that means that the selling pressure can have a bigger negative impact on the market. In terms of the Fed's positioning, the Fed has really we've discussed this on your show before, they have two arrows in their quiver. They have a big hammer, which is to raise rates, and they have a smaller one which is to tell people they're going to raise rates, which is considered moral suasion. Greenspan famously during the tech bubble talked about irrational exuberance to try to talk the market down. But what we've been seeing now is actual sequential hikes at the Fed, quarter-point hikes, but it was the rather aggressive stance they took on interest rates at the Fed to say, not just have we been raising rates, but it was that targeting or that forecasting that they suggested would be a continued tightening stance, and tightening means higher rates. The next Fed meeting, I believe, is around the 20th of this month, so that's very soon. At one point, it was deemed that it was pretty much considered de facto that they would raise rates, and at one point it was projecting that rates might get another 3 hikes next year. That was a fairly aggressive stance, and it was to to link up with the fact that we had 4.2% GDP growth in the second quarter, which is huge, huge growth, and they raise rates to try and temper excess economic growth and try to avoid inflation.
Mm-hmm. Okay, so all of that notwithstanding, to what extent do you see the burgeoning trade war with China, where now China has blocked the sale of 15% of the phones available from Apple in China in a retaliatory move to counteract the arrest of the CFO of Huawei Corporation. So that looks like to me that could sort of continue to catalyze increasing weakness going into Q1 2019, especially if it doesn't get resolved. What do you see happening there?
Well, I mean, it's obviously messy and it's creating concern. The markets are focusing on what can go wrong right now, and certainly a further escalation of tensions between China and the U.S. is not positive for the markets. The market's reacting accordingly. Each time the market rallies, we saw it last week, the Dow was up several hundred points and ends up closing down on the day, and we're seeing that today as well. I think it was up 370 at one point today, and has sunk back into negative territory the last time I looked. But I think that there's still potential for obviously tensions to cool off. That this is, I wouldn't say that arrests are necessarily part of a negotiating strategy, but there's certainly room to put this away and to draw it back, because there were positive talks even at the G20. That was the day of the arrest, ironically, up here in Vancouver, when they were having dinner down in Buenos Aires. So I think that there were constructive messages coming out of there, and I think even today it was indicated that there might be some, I guess, better news coming out. But until there's tangible news, the tensions are going to lead to this concern, and probably not just volatility, but volatility to the downside.
Mm-hmm. Okay, so oil and gas prices are in the crapper thanks to newfound inventories globally. You've got commodity prices on the metals sort of wallowing around, cyclical lows. You've got trade tensions. You've got the interest rates now being walked back in an effort to catalyze some positivity in the sentiment of investors. Is any of this going to have the effect that is desired by the Fed in suggesting they're not going to raise rates now? Do you think it's enough to offset the negativity?
I think that in due time, even over a few quarters, it will, I think, have a positive impact. I mean, the market was concerned because the projection from the Fed was the intention to raise rates up to 3 times next year. If you look at the futures market, and the bond futures are now indicating that, and even the shorter part of the Treasury curve are indicating that the market's not expecting that, and we've actually had rallies in the bond market of late. So I think that's a positive. If we see maybe rates sticking around where they are, it's probably going to be much more healthy for continued reasonable economic growth out of the States, the largest economy. And I think that the consumer confidence is the key as well. And consumer confidence and business spending intentions, those are both leading indicators. And consumer confidence obviously has been ripping and tearing on the upside. It's been very, very strong in the U.S., and we're seeing that in retail sales. When you have market volatility like this, and Americans are the biggest, American people as a citizenry in the world have the largest exposure to equity markets anywhere on the world. They have, on average, 60% of their net worth outside of their home is in equities rather than in fixed income. So when, as the stock market goes, so goes the psychology of consumer spending in the U.S. In Canada, the numbers are about reversed. 40% of Canadians' net worth outside their home is probably in stocks. Just a general conservative, more conservative posture. So when you have volatility, including downside, downdrafts, it hurts consumer confidence. That means that the projections will probably be for a slower spending intention, And that in itself will probably be signaling, in addition to other factors like weaker commodity prices, which are also a leading indicator because of that long lead time to buy raw materials to manufacture, leading to perhaps a general sentiment both in the markets, which is key, and the Fed's actual intent that they don't need to raise rates as aggressively next year, or perhaps at all. That's unclear, but that's a positive underpinning for the economy and thus profits in the stock market.
Okay, so where do you see attractive opportunities? What asset classes, what segments within those asset classes in 2019?
Well, right out of the gate, interest sensitives are probably, and we're seeing some attempt to rally some of those utility stocks, and even the bonds had rallied. So initially when you get this kind of dislocation, and there was a sell-off in the interest sensitives initially, I think that's, and when money comes back into the equity markets after being pulled out for cash until people figure out what they'd like to do, typically the money goes back in slowly, but it also goes back in some of the most conservative elements of the market. And it could be argued that you need a flat to a positive interest rate forecast, meaning not a rising strategy, but a flat to easing strategy. I don't know if easing's on the forefront, but just a neutral stance is positive for equities, positive for the economy. So interest sensitives would be one of the first places to look, and that is a natural pocket for money to come back in, and then on that basis, then people will figure out where the where the beneficiaries of other market conditions are.
And give me some examples of some interest sensitives.
Well, pipelines, utilities, even REITs.
Okay,
real estate trusts.
Interest sensitives for our audience?
Where you have a dividend yield probably north of 3%, especially in the U.S., because yields tend to be lower, and maybe 3.5% and higher in Canada. Those would be interest sensitives.
Okay, great. All right, Steve, let's leave it there. We'll come back to you soon. Thanks for joining me today.
My pleasure.